Good day, and thank you for joining us. We begin with developments in the global silver market that are drawing increasing attention across physical trading hubs and industrial supply chains. While the commonly quoted reference price for silver is currently shown at 73, that figure is not reflecting what many buyers are encountering in real-world transactions. In several regions where physical silver bars are actively exchanged, reported prices are significantly higher, ranging from 90 to as much as 100 for the same ounce. This gap between the quoted reference price and the price paid for physical metal is not being described as a routine premium. It is being presented as a signal that points to a deeper structural divide within the silver market. At the center of this situation is a growing separation between what is described as the paper market and the physical market. The paper market reflects reference prices derived from financial instruments and contracts, while the physical market reflects the cost of acquiring actual metal that can be delivered, stored, and used. According to the information being discussed, these two markets are no longer moving in close alignment. As this gap widens, the concern being raised is not about gradual price movement, but about the potential for sudden and sharp adjustments when pressures can no longer be absorbed. It is important to clarify what the 73 figure represents. That number is identified as a paper reference price. It does not account for additional costs that most buyers face when attempting to acquire physical silver in meaningful quantities. Fees, taxes, fabrication expenses, and limited availability all contribute to higher all-in prices. As a result, many buyers are unable to purchase physical silver at or near the reference level. The situation being described is not framed as a shortage that may occur in the future. Instead, it is characterized as a shortage that already exists but is unevenly distributed across regions and markets. This uneven distribution is central to understanding current conditions. Shortages, as described, do not appear with dramatic announcements. They emerge through practical signals such as products being marked sold out, purchases requiring price quotes instead of fixed listings, and delivery timelines extending by weeks. They also appear when street-level prices no longer follow what is displayed on trading screens. These indicators are being observed across multiple markets, suggesting that physical silver is increasingly behaving differently from its paper representation. Reports from several major physical trading hubs illustrate this pattern. In Dubai, dealers are said to be quoting prices that sit well above the reference price. In parts of China, even when futures prices appear relatively stable, factors such as value-added tax and logistical constraints can drive delivered prices substantially higher. In India, multiple layers of taxation combined with strong local demand add further upward pressure. In countries including Turkey and Pakistan, import costs and currency-related pressures can turn each ounce of silver into a high-cost purchase. Although the circumstances vary by country, the pattern remains consistent. The quoted price suggests one reality, while the buyer's actual cost reflects another. This divergence raises a critical question. If the paper market can indicate a price of 73, while physical transactions occur closer to 95, what would happen if the paper price were to fall further? The question being posed is whether physical sellers would follow such declines, or whether they would simply withdraw supply from the market. This question becomes more significant because silver is no longer portrayed as a niche or collectible asset. It is described as a foundational industrial material with widespread use. Silver is identified as a key input across multiple sectors, including solar technology, electronics, power infrastructure, fifth-generation communications, electric vehicles, defense applications, and medical uses. These industries rely on consistent access to silver, and their demand does not pause in response to price fluctuations on a chart. This industrial demand is described as a continuous force, contributing to sustained pressure on available supply. The discussion emphasizes that this presentation is intended to be educational rather than promotional or speculative. The focus is placed on risk awareness and reasoning based on observable conditions. Silver supply, it is noted, does not respond quickly to rising demand. New production cannot be brought online rapidly. Mining projects require extended timelines for permitting and development. In many established mining regions, ore grades are declining and capital investment requirements are increasing. Even when a mining project is viable, years can pass before it contributes meaningful output. This means that near-term demand cannot be met by long-term supply solutions. As demand continues to lean forward and supply responds slowly, pressure accumulates within the system. This pressure is likened not to a gradual release, but to a situation where stress builds until it is resolved abruptly. Attention is also drawn to discussions around multi-year supply deficits. While various figures and charts are often cited, the core mechanism is presented in simple terms. When consumption exceeds replacement, inventories decline. As inventories shrink, market sensitivity increases. In such an environment, premiums charged for physical delivery begin to serve as the primary indicator of price discovery, rather than paper quotation. Once premiums take on this role, the paper price is described as losing practical relevance for those seeking delivery. Another indicator highlighted is the movement of physical metal itself. When availability tightens, silver is said not only to become more expensive, but also more mobile. It flows from regions with weaker demand to those with stronger demand, driven by arbitrage opportunities. If a clear price advantage exists between regions, metal moves accordingly, crossing borders and oceans in response to those incentives. All of these developments form the backdrop to a market that is increasingly shaped by delivery conditions rather than screen prices. As we continue, we will take a closer look at how policy measures, taxation, industrial behavior, and inventory dynamics are contributing to this divide, and what signals are emerging from within the physical supply chain. Stay with us as we transition into the next part of this report, where the detailed breakdown of these factors continues. We continue now with a closer examination of the forces reinforcing the divide between paper pricing and physical availability in the global silver market. One of the additional layers shaping this situation is policy. When a major refining or manufacturing center introduces even modest restrictions on exports or licensing, the impact can extend far beyond the scope of the rule itself. Whether such measures are targeted, temporary, or administrative in nature, the outcome is often the same. Uncertainty increases, delivery schedules lengthen, and buyers respond by placing larger or earlier orders to protect their supply chains. That behavior alone can strain availability, not because demand has fundamentally changed, but because confidence in uninterrupted access has weakened. In these conditions, the market is not driven solely by end-use consumption. It is influenced by what is described as precautionary demand. When uncertainty enters the system, buyers do not wait for shelves to empty. They act preemptively. This is especially true for industrial operators whose production schedules cannot tolerate delays. For such buyers, paying a higher price is often preferable to risking a missed delivery. As a result, higher prices become embedded not through speculation, but through operational necessity. This environment has reportedly led to more direct engagement between industrial buyers and producers. Rather than relying on spot markets, some industrial participants are said to be approaching mines to secure long-term supply arrangements. These actions are not characterized as speculative, but as efforts to reserve and control access to essential inputs. When supply is locked into long-term contracts, less metal remains available for open market transactions. This reduction in what is sometimes referred to as the free float makes the remaining market more sensitive to shifts in demand. As the freely available supply contracts, price responses can become more abrupt. This dynamic is often overlooked by observers who assume that price is set by a single, unified market. The distinction being drawn here is between markets based on contractual promises and markets based on deliverable material. In periods of stress, the market that can deliver physical metal is described as having ultimate authority, because physical constraints cannot be bypassed by financial instruments. Taxation is another structural factor highlighted in this discussion. In countries where silver is subject to significant value-added taxes, the impact on final prices is substantial. A tax rate of 13%, for example, represents a meaningful increase that alters purchasing behavior. Such taxes influence where metal flows, who is able to buy, and how much inventory businesses must maintain. They also affect perception. When reference prices fall, buyers may expect relief, but if taxes and fees keep the out, the door price elevated, those expectations are not met. In this way, declining paper prices may offer little practical benefit to physical buyers. When taxes rise at the same time that supply is constrained, local physical prices can remain elevated even as reference prices decline. This phenomenon is described as decoupling, and it reinforces the notion that the two markets are operating under different rules. Premiums, often dismissed as temporary distortions, are presented here as potentially structural features in a market experiencing ongoing deficits. If supply imbalances persist, premiums may no longer revert to historical norms. This leads to a critical reassessment of how price signals are interpreted. Instead of asking when reference prices will align with physical costs, the more relevant question becomes when participants will stop relying on reference prices altogether. Paper prices are described as being anchored in confidence, while physical prices are anchored in scarcity. Confidence can change quickly, scarcity cannot. When confidence erodes, price adjustments can be sudden rather than gradual. Several key signals are identified as more meaningful than daily price movements. Persistent high premiums across multiple regions are highlighted as a primary indicator. In contrast, short-term volatility in paper markets that does not affect delivery conditions is characterized as noise. The timeline for supply expansion is also emphasized. With new mining output requiring years to materialize, tight conditions can endure longer than many expect. Additionally, the ongoing flow of metal toward regions offering stronger bids suggests that inventories in other regions may not replenish easily. Industrial purchasing behavior remains another critical element. When large buyers secure long-term contracts, they remove optionality from the market. This limits flexibility and increases sensitivity to unexpected demand. These dynamics contribute to a situation where price responses may be delayed in paper markets, but accelerated in physical ones. A common question raised in this context is why prices have not already surged dramatically if shortages are present. The explanation offered is that paper markets can absorb pressure by expanding contractual volume, creating the appearance of ample supply. This can delay recognition of physical constraints. However, while paper markets can expand promises, they cannot expand material. The delay does not eliminate the underlying issue. It merely postpones the point at which multiple buyers seek the same limited supply simultaneously. From this perspective, the primary risk is not short-term price declines. The more significant risk is the inability to obtain physical metal when needed, or only being able to do so at sharply higher premium. For those focused on long-term resilience rather than short-term trading, availability and liquidity are presented as more important considerations than chart movements. Different approaches are outlined depending on objectives. Those acquiring silver as a form of insurance are described as prioritizing ownership, liquidity, and widely recognized products. Novelty or specialized items are not emphasized. For traders, timing, spreads, and exit options are identified as central concerns. For those involved in supply-side investments, such as mining or refining companies, factors like jurisdictional risk, balance sheets, and exposure to price movements are highlighted as critical, since not all companies benefit equally from higher prices. In the context of physical silver, practicality is emphasized. In a genuine supply squeeze, weight and standardization matter more than aesthetics. Industrial users require feedstock, not decorative products. As a result, widely recognized bullion forms that are easy to verify and trade are described as having advantages. Managing premiums paid today is presented as a way to reduce reliance on favorable conditions later. Volatility in paper prices is described as a psychological tool that can induce poor decision making. Rapid fluctuations can cause participants to confuse price with value. In contrast, when physical availability is tight, declines in reference prices may present opportunities only if metal can actually be sourced at reasonable all-in costs. The distinction between reference prices and total acquisition costs is repeatedly emphasized. Silver's role as a strategic material is also addressed. Its properties, including conductivity, reflectivity, and antimicrobial characteristics, are described as difficult to replace without trade. While substitutes may exist in theory, they often involve compromises in performance, efficiency, or longevity. In industries operating with narrow margins, such compromises are not easily accepted. This contributes to demand that is described as persistent rather than discretionary. Attention is also drawn to inventory systems linked to futures delivery. When vault inventories decline, system flexibility diminishes. In such conditions, even a modest increase in demand can trigger significant disruptions. These disruptions may lead to allocation measures, purchasing limits, or prioritization of certain customers. When such mechanisms appear, public access to metal can tighten rapidly. At that point, behavior shifts. Sellers become reluctant, and buyers become more aggressive. Hoarding replaces circulation, intensifying tightness into a squeeze. Fabrication capacity adds another constraint. Even when raw silver exists, converting it into finished products requires time and infrastructure. Mints, refiners, and shipping networks all have limits. During periods of elevated demand, these bottlenecks can amplify premiums independently of reference prices. Recycling is sometimes cited as a solution, but the discussion here highlights its limitations. Silver is often used in very small quantities across a vast number of products. Recovering it is time-consuming and costly, and much of it remains embedded in long-life applications for years or decades. As a result, recycled supply may not return to the market in the timeframe when shortages are most acute. Taken together, these factors suggest that waiting for paper markets to confirm physical tightness may leave participants reacting rather than preparing. When recognition finally occurs, conditions may already be constrained. The emphasis throughout remains on process rather than prediction, on discipline rather than emotion, and on resilience rather than speculation. As this report concludes, the central message remains clear. In a tightening commodity market, the most important signals are not always visible on price charts. Availability, delivery timelines, and real-world transaction costs provide a clearer picture of underlying conditions. When industrial demand competes directly with public buyers, the dynamics can change quickly. In such moments, the quoted price becomes secondary to the question of whether metal can be obtained at all. That brings us to the close of this coverage. We will continue to monitor developments across physical markets, policy actions, and supply chains as this situation evolves. Thank you for staying with us.